Will the housing market go up or go down in 2024? Let's look at the data. This top chart is from the Federal Reserve's website. It's the median sale price of houses. You can see in 2010, from the Great Recession, housing prices have continued to go up, and in 2020 went parabolic. If you started looking for a house in 2020, it could be quite confusing on why the house prices were skyrocketing. Some of the reasons you may have heard for the housing prices going up so much so fast, because some tech workers were moving from the cities to the suburbs, and that was driving up the cost. And on a micro level, like you've seen what happened to Austin, Texas, where a lot of tech workers went down there and drove up the housing cost. But the fact remains, in cities also the prices have been rising. They've been rising across the board, all across the United States. Now let's look at another chart from the Federal Reserve's website. Another story or narrative that you may have heard is we do not have enough houses. We have a housing shortage. But if you look on the Federal Reserve's website, for total houses in the United States, you can see there's not a big spike here. It just kind of gradually goes up. So the housing unit has been rising. Now, if we had a huge population growth, and here again is on the Federal Reserve's website, this is total population, you can see it's just steadily going up too. So there's no spikes here with population or housing unit. So let's look at the real reason housing prices have gone up across the board. We had just looked at the median sale home prices, and we talked about how they continue to go up and then spiked in 2020. Now, if you look down here at the Federal Reserve's balance sheet, this balance sheet represents how much liquidity or how much money is pumped into the economy. The Fed does this by buying mortgage-backed securities from the banks. They do this with new money that they create out of thin air. So you can see throughout history, their balance sheet has been pretty low, under $1 trillion. But in 2008, when they had the big financial crisis, they started buying mortgage-backed securities from the bank and creating that new money. And you can see where their balance sheet went up. Now, what this represents is inflation. It's more money in the system, meaning your money is worth less. And that's never been so apparent than what happened in 2020. After the Great Recession in 2008, the Federal Reserve lowered interest rates, which stimulated the economy. But once they lowered interest rates, they needed another tool to stimulate the economy even more. And that tool is called quantitative easing. And that's what you're looking at here on the Fed's balance sheet, is the quantitative easing, when they create new money to go buy assets. And you can see right here on their balance sheet, it says total assets. The majority of these purchases are mortgage-backed securities from the banks. Quantitative easing is just a fancy way to say they're expanding the money supply. And you can see they kept expanding it. And in 2018, they wanted to start trying to pull back some of that money that they pumped into the economy because inflation starts happening. Prices start going higher. But in 2020, they had to reverse course by an unprecedented amount of liquidity into the markets. This line right here that goes straight up and it continues to go up, this is an enormous amount of money that was pumped into the economy. And when that money is pumped into the economy, you see an enormous amount of inflation in asset prices. And that's what you see right here in 2020 when you've seen the housing prices explode in value, doubling and tripling. And in reality, it's not that the prices are going up, it's that the purchasing power of your money is going down. Your money is being devalued. Your money's worthless. The reason that we want to talk about this is because we want to make an informed decision on when to buy a house. You wouldn't want to buy a house at the top of a market. When the Federal Reserve lowers interest rates and starts quantitative easing, asset prices are going to go up, like house prices will go up. And the reverse happens when the Federal Reserve wants to slow the economy. They'll raise interest rates like you're seeing happening now, and they'll start quantitative tightening. So here on their balance sheet, you can see where they started quantitative tightening right here. And then when they had the bank bailout in California, they had to reverse and do quantitative easing again. And then they started quantitative tightening back again. But you can see there is a lag in housing prices versus when they start quantitative easing and quantitative tightening. You can see even right here when they did the bank bailout and reverse course and started quantitative easing again, you can see the house prices started going back up. So the question is, what is the Fed going to do? What is the Federal Reserve going to do? That will tell us what's going to happen to the housing market prices. Here's Jerome Powell. He's the head of the Federal Reserve. Jerome Powell, with a committee of bankers, set monetary policy. And on December 13th, 2023, Powell says the Fed will stay the course on quantitative tightening. And like we talked about, when they tighten, asset prices come down. And down here at the bottom, you'll see where it says the Federal Reserve had shed more than $1 trillion, like we looked at in the chart. Here's the Federal Reserve's balance sheet, and you can see from the top to where we are now, it's about $1 trillion they've shed off. At the top of the balance sheet was about $9 trillion. They've shed it off $1 trillion, so they're about at $8 trillion. So what they're going to try to do is keep this going down. Officials say their quantitative tightening exercise can continue on for the foreseeable future. They said the same thing about interest rates, higher for longer. If the Federal Reserve continues on their restrictive monetary policy, then we should see home prices fall. If you've been sitting on the sidelines waiting to buy a house, I know it can be hard. And it's just a decision you'll have to make. But I would say keep an eye on what the Fed does. They're the ones who are in control of the asset prices. If you see the Federal Reserve change course, then you know asset prices are going to go back up. But there is a lag between when the Federal Reserve sets monetary policy and when asset prices change. This is the Federal Reserve's funds effective rate. This influences interest rates. And right here before the Great Recession of 2008-2010, you can see interest rates going up. Then once unemployment happens, you can see where we had the Great Recession and the Federal Reserve started lowering interest rates. So I would think the same thing's going to happen here. At some point, this tightening is going to cause a slowdown in the economy. And once unemployment gets high enough, the Federal Reserve will reverse course and lower interest rates and start quantitative easing again, which will raise asset prices. I would say once they reverse course, you'd have about 6 months to a year to go out and buy your house. If you're going to finance your house, I think it would be best to wait till interest rates are rock bottom. So you'll see asset prices come down and then you'll see interest rates come down. That would be the perfect time to buy. Right now is the worst time to buy. Asset prices are high, interest rates are high. Let me know what you think below. I'd love to hear your thoughts on this crazy housing market.